January 10, 2011. Real Estate Capital Scoreboard January 2011. Chicago, Illinois, January 10, 2011. Realty markets are rebounding, although at a slow and sporadic pace. Each property sector shows varied investor demand, strictly driven by location, quality and cash flow dynamics as broadly outlined below. Multifamily, as has been the case for most of this decade, investors clamor for Class A apartments in major markets. Extremely aggressive pricing leads many to consider new construction in the major markets based on rapidly rising rental rates and tight supply. In many cases, investor demand is overflowing into secondary markets, driving up pricing across the entire sector. As long as the GSEs are active players in the financing arena, expect the apartment sector to maintain peak prices, often valued with below 6% cap rates. Net lease, single-tenant, net lease properties in nearly all categories enjoy strong investor demand. Overall pricing ranges from 6% cap rates or more, depending upon credit and length of lease term. This market segment is the most sensitive to interest rate volatility and should continue to show solid performance gains, depending upon cost of capital. Industrial/warehouse, economic recovery helps this property sector maintain a strong foothold of investor demand. Industrial properties tend to rebound faster than other commercial property sectors as overbuilding as spec development is closely linked to the overall economy, keeping capital in check with supply and demand. Expect solid pricing in the gateway markets along the coasts and in the Midwest. Cap rates will mirror net lease assets. Retail properties are more location-driven than any other asset class. While credit tendency is important, sales performance of each location drives pricing as many retailers represent marginal credit. Existing and new construction infill properties are in strong investor demand with cap rates mirroring the highest quality properties in other property sectors. Office property values have been vacillating during the past year as office space dynamics greatly vary in different parts of the country and downtown versus outlying locations. Core CBD properties maintain strong pricing with cap rates hovering in the 6% to 7% range for newer, multi-tenant assets with long-term leases. Conversely, many investors avoid the suburbs as oversupply and employment fundamentals lag. Other, lodging, senior housing, recreational and other property types are also rebounding, but on an extremely selective basis. These business-type properties vary widely in values and are heavily linked to sponsorship and performance. As such, valuation metrics continue to emerge. Gene Peck, director of the Real Estate Capital Institute, predicts, "The new year brings more optimism and hope as the worst seems to be behind us." Also stating, "While economic recovery is in motion, throwing caution in the wind is a reckless investment strategy." Market volatility is very property type and location driven, and proper due diligence is more important than ever. February 1, 2011. Real Estate Capital Scoreboard February 2011. Chicago, Illinois, February 1, 2011. Washington's legislative impact on income property real estate surfaces as the hot topic, for example, agency's fate, Frank Dodd. Yet the action timeline is still not clearly defined, or not in the immediate future. Instead, the markets are still digging out of many problems, supply/demand issues. Meanwhile, the ownership burdens ease as capital has returned to full with a plethora of funding options resurfacing as noted below. Capital sources offer more flexibility, including reducing fees, prepayment penalties and other restrictions to keep existing performing loans as well as winning new business. More bridge and subordinate debt lenders return to the funding arena. Senior debt lenders cautiously allow additional leverage, although subordinate debt is more carefully scrutinized, including source and uses, escrows, default provisions and remedies, etc. The competition for larger loans is pushing a number of lenders to go down in size. Most permanent loan spreads over treasuries staying since last fall, as funding sources have scant investment alternatives with similar risk profiles. The market prefers longer-term debt instruments. As for overall pricing, 5.5% often surfaces as a floor on 10-year funds for more typical leverage deals. Rate floor are rare for lower leverage, conservative loans. While mortgage spreads stay the course, treasuries are another story. Short-term obligations are at record-wide spreads, suggesting the markets are concerned about stagflation. Such pricing indicates that many investors believe the Fed will be more timid about raising rates, despite inflation fears, deficit spending and other global fiscal policy concerns. Strong sponsorship with partially distressed portfolios voluntarily surrenders assets to lenders as if no strategic value play exists after all other reasonable options are exhausted. Depending upon the circumstances, lenders cooperate with borrowers as long as all parties act in good faith. The Real Estate Capital Institute's director, Jean Peck, suggests recovering capital markets provide fuel for accelerating loan workouts. In general, funding sources are maintaining underwriting discipline. Only truly troubled and ill-conceived projects will fail.
March 1, 2011 Real Estate Capital Scoreboard March 2011. Chicago, Illinois, March 1, 2011. As spring approaches, economic recovery is delicate, but more encouraging signs are surfacing within specific realty product sectors and markets demonstrating job growth. For example, many warehouse markets enjoy higher occupancies as global trade rebounds. In addition, consumers are renewing spending, helping to ease oversupply concerns in the retail sector. Of course, problems in the housing sector continue to translate to higher profits in most multifamily markets. The Middle East tensions are favorably influencing lower mortgage interest rates. During February, declining Treasury yields combined with compressing mortgage spreads helped interest rates stay in the 4.5% to 6% range for many types of fixed-rate, longer-term loans. Important trends changing the commercial property financing landscape include: economic outlook. The usual leader in economic recovery, the housing industry remains depressed. Housing starts are nearly at a standstill. Yet the economy is rebounding at a modest tempo with overall growth pegged at about 3%. Such a pace is still below historical rebounds following severe recessions. Nonetheless, the unemployment rate is expected to dip below 9%, still a favorable statistic for overall income realty markets. Also on the inflation front, increases are minimal as economic recovery moves at a slow pace, benchmarked below 2%. Low rates. In the short term, the Fed's active monetary decisions are preserving rates at historically insignificant levels. However, investors are nervous about longer-term consequences including global growth and fiscal spending. If overall mortgage rates remain in the mid-single-digit range, realty values will remain at healthier levels, otherwise higher rates will lead to more valuation pressures. Demand for quality. During the past 3 quarters, further consolidation occurring as commercial realty markets bask in the abundant supply of attractively priced debt capital. Although more equity is required, and readily available, universal investor demand is unabated for quality, income-producing properties. Second-tier assets continue to suffer and a wide pricing differential exists between various quality classes. Restrictive underwriting. As Wall Street revives the CMBS platform, mortgage delinquency rates reach new highs, hovering just below 10%. New loan origination underwriting is now more restrictive due to lingering legacy issues. As a result, life companies, and other lenders void of major legacy loans, are more competitive in this funding arena. In addition, while pricing is relatively attractive, the net result across the board for newly originated loans includes more restrictive covenants, mandatory collection of reserves and escrows and loan covenants. Investors demand adequate protections and want reduced risks in the event problems emerge. The Real Estate Capital Institute's Jean Peck emphasizes, conditions are improving and optimism is in the air. New construction should selectively rebound as demand is unabated for high-quality, urban infill properties.
April 1, 2011. Real Estate Capital Scoreboard-April, 2011. Chicago, Illinois, April 1, 2011. Modest economic growth steadily fuels the commercial realty markets with abundant debt and equity funds staying in step. Inflation pressures are under control in the short term, alleviating concerns of a double-dip recession. However, maintaining modest growth proves challenging under current economic conditions as unemployment, weak housing conditions, cautious consumer spending, concerns about Europe and the Middle East and lack of liquidity for many business sectors still haunts entrepreneurial investment appetite. Regardless, realty capital markets are undoubtedly back to more normal levels as evidenced by the REIT and CMBS market rebound. The number of capital providers and financing structures are far superior to those provided a few years ago based upon several factors. Solid values. Conservative investors flock to the best quality, best located properties, accepting lower cap rates in lieu of volatility. For instance, multifamily properties support 6.5% cap rates on a national average. Interestingly, same property dynamics show about a 400 basis point range within the Class ABC quality spectrum. Public market demand. The strongest evidence of solid gains in the commercial real estate (CRE) sector rests with the public markets. Appetite for income properties via REITs offers strong performance and tight pricing. The underestimated rebound in the capital markets allows these companies to sell stock at very competitive rates. Few attractive alternatives are offered in conventional stocks and bonds. Many investors firmly believe that the commercial property sector has bottomed out and is set for a steady recovery. Prudent underwriting. Rating agencies have increased subordination levels, translating to higher rated tranches, which are more appealing to investors. Furthermore, CMBS spreads dramatically tightened to more historical norms of about 250 basis points. BP buyers are keeping new issues in check. Borrowers now have more varied options in addition to life companies and banks. Real equity. Pricing concerns plague non-stabilized properties, especially in competition with underperforming maturing loans. Extremely conservative loans backed by substantial equity are the only panacea for this sector. That said, savvy investors purchasing such assets at reset prices on an all-cash basis are expected to handsomely profit, if projects are well conceived and in strategic locations. Gene Peck of the Real Estate Capital Institute forecasts spring capital markets are clearly in full swing as proof of REIT and CMBS dynamics. Adding, CMBS, and other investors are out in full force armed with lots of cash, but still maintain discipline as the memories are still fresh of the Great Recession. May 4, 2011. Real Estate Capital Scoreboard-May, 2011. Chicago, Illinois, May 4, 2011. Real estate finance fundamentals are favorably gravitating towards borrowing as the triple play of lower treasury rates, compressing mortgage spreads and higher leverage levels fall into place. During the past month, 5- and 10-year treasuries dropped by more than 15 basis points, while lenders slightly tightened spreads to remain competitive as more capital floods the markets. Also, with values stabilizing for most types of income properties, funding sources are willing to offer additional proceeds. Current highlights include overall rates, with mortgages rates at historically low levels ranging in the 4% to 5.5% for longer-term debt. Borrowers prefer fixed-rate debt as pricing differential is barely significant versus floating-rate formats. That said, many lenders are removing floating-rate floors to remain competitive. Performance. The markets have bottomed out as nearly all property sectors demonstrate improved profitability. Apartments continue to outperform all other sectors as low home values and slow sale velocity challenge the residential market, making renting more attractive to the otherwise home buyers. In fact, for the first time in years, home ownership is less costly than renting in many markets. Hospitality is on a rebound with business travel on the rise. Office and industrial demand is up, although at cautious levels. Lastly, retail rebounds as slowly rising consumer leads to better store sales and expansion plans for retailers. Investors are noticing these trends as evidenced by bidding activities increasing substantially from last year and, in fact, approaching pre-recession levels for well-leased properties. Capital. Throughout this spring, substantial funds are available for funding most types of income property real estate. Funding sources are keenly aware of competition for quality properties with cash flows. Pricing remains tight. Conduit lenders are definitely back in the market offering higher leverage, while life companies compete on pricing and agencies still dominate the multifamily arena. As profitability returns and workouts are successfully addressed, banks are back seeking new business as well. In general, lenders are more creative in looking at stabilizing assets, willing to bid earlier in the process to capture loans. However, funding projects with ongoing leasing issues is still a challenge. The Real Estate Capital Institute's Jean Peck suggests expect more liberal underwriting standards as lenders scramble for a limited supply of quality loans. She also believes capital sources are certainly lowering yield expectations, but sooner or later, more risks will have to be taken as well. This may include higher leverage levels and lower debt coverage.
June 1, 2011. Real Estate Capital Scoreboard-June, 2011. Chicago, Illinois, June 1, 2011. The markets are heating up with the summer months. Once again, interest rates continue trending downward and spreads narrow as funding sources case prime quality investments. Investors are rethinking and retooling their funding programs based on the following. Higher leverage. To stay competitive, creative lenders are teaming up with mezzanine debt players to provide a one-stop funding solution based on a higher leverage loan. The combined leverage often results in loans of up to 85% with blended interest rates in the 6% or higher range, a premium over conventional first mortgage debt. Mezzanine/preferred equity, with yields tightening in the lower single-digit range, the preference for entertaining more equity rather than debt risk is appealing. Targets of 15% or more are still available within this funding format. However, the amount of higher quality projects are bid up quickly, even in challenging markets as many investors are squeezed out of primary markets. Alternative property types. Existing value-add opportunities for favorite property types are sparse. Lodging, self-storage, data centers, flex industrial/office are gaining attention. Overall yields for such properties also are approaching the mid-teens for stabilized assets, while repositioning and value creation situations approach 20% or more. New construction. A small window exists for new construction, as lenders are re-entering the marketplace with construction funds. Through most of 2012, new construction will be limited, but investment pipeline is increasing for hard-to-find investments, particularly multifamily assets which are trading at pricing close to replacement costs. Since interest rates are extremely low, return on development cost are approaching a very narrow band, often within 100 basis points or less of the exit capitalization rate. Ms. Jean Peck, Research Director for the Real Estate Capital Institute, forecasts very little room remains for absolute rates to drop further. Peck thinks the main focus must be on improved cash flow performance through expense reductions and more aggressive income growth, where available. July 5, 2011. Real Estate Capital Scoreboard-July, 2011. Chicago, Illinois, July 1, 2011. The Fed quantitative easing policies, the Euro monetary crisis, rising concerns about inflation in China and the overflow of capital into commercial real estate are all tampering with low mortgage rates. Treasuries are rising and the Federal Reserve has minimal room to continue monetary easing, despite fragile economic conditions. Throughout the past week, Treasury rates have risen in excess of 3.1%, the highest since the end of May. Rates are already bouncing along the bottom of the curve and can only be expected to move upward. Just as treasuries rise, mortgage spreads also widened, by about 30 to 50 basis points. Concerns loom over CMBS performance. The rating agencies warn about the rapid reintroduction of pro forma cash flow projections as part of underwriting new loans. To stay competitive, conduit lenders react by tightening underwriting and pushing back on leverage. However, such lenders still offer cash-outs and a wider spectrum of funding programs, for example, combination permanent loan with mezz debt. In the midst of such change, multifamily properties still capture the lowest rates. Despite concerns about the future of agency lending, Freddie Mac and Fannie Mae are sought by investors and borrowers alike. Improving profitability, the government's continued backing of the housing sector and no real short-term alternative solutions are reasons for guarded optimism for this funding sector to stay viable. The lodging industry is the bright star in the commercial property sector, and room rates rise and occupancy levels recover to pre-recession levels. This sector is also supply constrained as few investors dare to venture into new construction in the foreseeable future. Lenders take note, selectively financing hospitality properties at pricing levels matching other more traditional commercial property types, although at leverage of 65% or below. Ms. Jean Peck of the Real Estate Capital Institute forecasts very little room remains for absolute rates to drop further. Peck notes, the main focus must be on improved cash flow performance through expense reductions and more aggressive income growth, where available.
August 6, 2011. Real Estate Capital Scoreboard August 2011. Chicago, Illinois, August 6, 2011. As the stock market hit news lows in the first week of this month, bond investors hardly fear the federal budget discussions and impending downgrades, helping keep mortgage rates low. Instead, low Treasury yields are driven by global financial market concerns and a double-dip recession. In the past month, Treasuries moved down to previous lower levels of the nearly a year ago, while floating rate pricing remains nearly unchanged. More recent concerns revolve around the fragile CMBS markets, as any savings in lower Treasury costs are absorbed by higher swap spreads. Spreads widened more than 100 basis points as note buyers are nervous about the market recovery and quality of securitized mortgage instruments. Look for more volatility in this lending sector for the remainder of the year, as more mortgage bonds are issued based on stabilized pricing. During the past year, income property sales volume has increased by at least 25%, as investors step back into the buying arena. Institutional demand for trophy assets, mostly from REITs, in major markets skews pricing dynamics even as market conditions improve. Such investors will even consider paying above replacement cost in select fortress markets as extremely high prices drive new construction. Greater profits await investors willing to consider non-downtown areas. Capitalization rates dive below 5% for CBD assets and are about 200 to 300 basis points wider in outlying areas. In search of more yield, private buyers now reign in secondary markets. Multifamily rental increases go unabated with growth rates of 7% or more in select supply-constrained markets. Population demographics with a larger younger workforce, rising rental rates, falling vacancies, limited supply and low mortgage costs are the ideal conditions for continued profitability in this property sector, especially in stronger employment markets. However, nothing lasts forever. Investors should take note of improving home ownership conditions, supply threats and other forces on the horizon. Low-cost mortgage debt is fueling new apartment construction and the conversion of existing condominium inventory. Furthermore, unsold home inventory is about 3 times the normal levels, creating an extremely attractive ownership scenario not seen in years. Many housing markets are at rock-bottom prices and home ownership is now less costly than renting in numerous cities. Lastly, banks are starting to loosen consumer credit and mortgage pricing based on historically low interest rates, adding even more reasons to consider ownership versus renting. The Real Estate Capital Institute's director, Jean Peck, professes that we're clearly at, or near, the bottom of the housing market and at the top of the rental market. She adds, "What goes up must come down, but the prospects are still very strong for owning core apartment assets."
September 2, 2011. Real Estate Capital Scoreboard September 2011. Chicago, Illinois, September 2, 2011. The nearly catastrophic stock market dive in the beginning of August triggered chaos in the CMBS world. The market was severely tested as borrowers and lenders scrambled to close on committed loans. Loans in process without rate locks were typically repriced 25 to 50 basis points. Securitized lenders ceased quoting loans until the turmoil subsided and some new loans widened by a full % or more, for borrowers needing to close deals within the first part of the month. The August pricing volatility varied as much as 200 basis points between balance sheet lenders and the CMBS sources for similar loan opportunities, an unusually wide pricing differential. Today life companies, agencies and banks hold steady on pricing and fleet equality instead. However, as Treasury yields continue to contract, lenders are carefully watching the markets for more pricing clarity. In many cases, rate floors are introduced to protect yields against too much downward movement in treasuries. All in all, absolute mortgage rates for standard loans remain nearly unchanged throughout the month, albeit spreads over treasuries are wider. Yet the flight to quality and risk segregation show dramatic pricing differentials above and beyond any floors. Competition for low-leverage apartment deals in primary markets, for example, dives into 4% for 10-year deals, 3.75% for 7-year deals and below 3.5% for 5-year deals. All rates are at generational record lows. Within the mortgage world, numerous factors account for such drastic mortgage rate volatility, but none more than economic uncertainty, both nationally and globally. The lack of faith in the economic recovery and domestic budget resolution forces investors onto the sidelines, bringing down Treasury pricing to insignificant levels. The Eurozone monetary crisis forces even more investors to purchase treasuries. In response, economists have been scaling back their forecasts for the second half of the year. And now that investors are returning from summer holidays and confronting Hurricane Irene issues, more volatility is expected as various quality of real estate is sorted into the correct pricing levels within different regions of the county. Ms. Jean Peck of the Real Estate Capital Institute indicates that, the realty capital markets are on a very bumpy road filled with unexpected twists and turns, as well as deep potholes from troubled deals. She suggests removing any volatility that an investor can is key. Drive slowly and watch closely for obstacles will be the most prudent actions for navigating through the remainder of the year. October 1, 2011. Real Estate Capital Scoreboard October 2011. Chicago, Illinois, October 1, 2011. Lackluster economic growth domestically, real estate capital markets spoke along at a measured pace. After investors returned from the summer holidays a few weeks ago, the demand is insatiable for quality assets of all classes as funds flood the market given minimal yields in the corporate and government bond markets. However, substantial pricing gaps and desirability between core properties and non-core assets, as well as primary and secondary markets. On a property-by-property basis, real estate capital markets are summarized as follows. Multifamily capitalization rates are near historical lows starting in the low 4% range in major markets along the coast. The high-end range for Class C properties in secondary markets is 400 basis points or more, again illustrating the dramatic difference in core versus non-core assets. Extremely low mortgage rates help drive down cap rates for this sector, especially with agency support, often in the mid-3% range or more for Class A properties. Industrial, strong demand exists for credit deals with capitalization rates starting below 5% for the right tenant/lease profile. However, more typical properties trade in the 6% to 7.5% range. Expect a cautious growth in this sector based upon modest rental increases. With strong credit, longer-term mortgage rates hover in the 4% to 5% range. Office: the saving grace with this sector is the lack of new supply. Rents are at, or near, the bottom with virtually no room for discounting. Value-add and opportunity plays dominate suburban office market transactions, while CBD core assets in major markets trade near the peak levels of 2007 as institutional investors seek shelter in high-quality assets. Retail: tenants are finding excellent opportunities to move into second-generation space vacated by bankrupt retailers. In most markets, a 4 to 5 year oversupply exists, although infill development opportunities may crop up. Developers are returning to more traditional retailing concepts including pharmacy and grocery-anchored centers, as online retailing makes more inroads into non-essential consumer spending. For the most part, lifestyle centers are the hardest-hit categories. Pricing and financing mirrors other commercial property sectors, depending upon credit profile, etc. Lodging: the lodging industry sales volume has nearly doubled from some of its historical lows. However, luxury and limited service projects, particularly in premier locations, still commands favorable capitalization rates as low as 6%, 8% or more is the norm for this sector for a vast majority of properties. Jean Peck, research director of the Real Estate Capital Institute, notes that since interest rates are ridiculously low, ownership focuses on preserving values through cost-cutting and other proactive management measures. November 1, 2011. Real Estate Capital Scoreboard November, 2011. Chicago, Illinois, November 1, 2011. Uncertain economic conditions impinge on commercial property sales, particularly older office, retail and industrial properties in secondary locations. Funding sources and investors alike are retreating from these asset classes as the lack of job growth office building sales, particularly for older properties in secondary locations. Lenders and investors alike are retreating as fewer businesses consider new leasing. With a GDP growth of about 2%, not enough jobs are generated to allow landlords to raise rents based on commercial space demand. Even though lingering problems face commercial property lending, funding sources are swollen with cash, as investors scramble to find some type of more attractive yields as compared with treasuries and corporate bonds. A brief overview based upon active funding sources is as follows. Agencies: the dominant multifamily funding sources for over a decade, the agencies compete on both price and leverage. While securitized lending stays depressed, the agencies continue to migrate towards such funding as mortgage note buyers maintain faith in the future of apartment performance backed by implied governmental guarantees. Also, the agencies are expanding prepackaged leverage offering of up to 90% in combination with mezzanine funding partners. Banks: with many legacy issues settled, banks are again active in the short-term fixed and floating-rate funding space. Since most new deals are of higher quality, banks hone in on sponsorship equity and guarantees for such properties, preferring to compete on pricing instead of leverage. For the right situation, banks will be the most competitive sources for loans with terms of 5 years or less, often dropping rate floors and providing more proceeds to strategic clients. On a case-by-case basis, recourse can be reduced or even eliminated. Life companies: the most active funding sector for longer-term permanent debt, the life companies aggressively compete for the highest quality conventional property types. This sector leads with competitive pricing instead of higher leverage or more risk. CMBS: after a brutal retreat in August, CMBS lenders cautiously return to the market, but softening cash flow fundamentals restrict the scope of qualified borrowers and financeable properties. At the same time, the securitization industry is plagued with higher spreads of at least 75 basis points or more in contrast to balance sheet lenders and loan syndication issues for larger funding in excess of $50 million. Lastly, CMBS lenders only offer rate estimates rather than lock into specific pricing as available hedging mechanisms are too costly, due to volatility, for any type of rate protection prior to funding. As such, Securitized lenders will only compete for higher-risk loans bypassed by other traditional lenders. The Real Estate Capital Institute's Jean Peck warns, record low interest rates aid realty cash flow performance, but economic uncertainty plagues any significant growth. She concludes, other than the multifamily and part of the healthcare properties sectors, the property markets will remain stagnant for most of 2012.
December 1, 2011 Real Estate Capital Scoreboard December, 2011. Chicago, Illinois, December 1, 2011. The jittery stock market keeps real estate capital on the forefront of activities, as investors flee towards attractive debt and equity yields offered by brick-and-mortar versus low-yielding corporate bonds and other less profitable investments. Even as markets fluctuate, interest rates remain steady with mortgage spreads continuing an overall downward draft with more CMBS and bridge lenders returning to the market. Market highlights for the month are as follows. Project cash flow is the be-all end-all any type of successful financing, although more new construction projects in select markets are now progressing. As interest rates decline, more lenders have been relaxing their reliance on debt coverage ratios as an underwriting standard. They are underwriting to more traditional benchmark levels, including 75% leverage, and debt yield has now become one of the most important underwriting metrics, particularly with the CMBS industry, hovering in the low double-digit range for non-multifamily properties. While fixed-rate debt is attractive, watch for rising international bank rates as European banks unravel their banking problems. Still extremely low, LIBOR has increased 20 basis points since summer, potentially creating more concerns about floating rate debt. Non-agency funding sources continue exploring alternative property types, over and above multifamily assets, as yields are driven to minimum levels within this asset class. Retail and industrial properties are the largest beneficiaries, yet office and lodging are gaining popularity. Key benchmark treasury rates, the 5 and 10-year notes, tighten to a range of about 100 basis points of each other, while overall spreads for mortgages are within 20 basis point premium for the shorter-term maturities. That said, commercial mortgage rates are still at historical lows and mortgage spreads over treasuries remain flat. In the next few months, expect mortgage spreads to tighten even further, as much as 50 to 75 basis points, as lenders remain awash with funds and continue to elect lower pricing, rather than compromising on asset quality. Within the past month, for example, CMBS pricing over swaps dropped 20 to 50 basis points. According to Jean Peck, the Real Estate Capital Institute's director, the commercial property sector is bifurcated into haves and have-nots, with a substantial difference existing between credit and non-credit financing options. The real estate markets are no different than the overall credit markets as far as trying to pinpoint successful businesses.